A very warm welcome to today's seminar on fiscal incentive for electric vehicles. My name is Patrick Lenain. I'm a senior associate with the Council on Economic Policies, and I will be the host of this webinar today. I'm thrilled to see many of you joining us today with a common interest in advancing sustainable transportation. It's very clear that the use of energy by road transportation needs to be transformed. There are no less than 1.3 billion vehicles running on gasoline and diesel fuel around the world. This huge number continues to increase at a rapid pace, especially in emerging nations. As a result of that, passenger cars account globally for about 1/4 of crude oil consumption and for a large share of carbon emissions. In addition to the impact on global warming, road transportation contributes to outdoor air pollution, which is estimated to cause millions of premature deaths. We need a more sustainable road transportation system that can move passengers and goods without causing harm to the environment and to human health. Electric vehicles are not a perfect solution in the very long term, but they can certainly help to reach net zero carbon emission by the mid-century. However, for the time being, electric cars still account only for a small share of sales. If we consider battery electric cars, their shares in new vehicles was only 14.6% last year in the European Union and 9% in the United States. So a lot remains to be done to encourage faster adoption of electric vehicles. Most governments provide tax credits, subsidies, and other fiscal incentive, but this is increasingly controversial in a period of fiscal pressure. Germany just decided to terminate its subsidies for electric vehicles in 2024. France has curtailed its support, and even Norway is doing the same. According to recent data, this has already led to a drop in the sales of new electric vehicles in January. To help us navigate this complex landscape, it is a pleasure to welcome three great panel speakers today. Askill Halse is Chief Research Economist at the Institute of Transport Economics in Norway. He has published many papers on different topics within transport economics, including the value of travel time, cost-benefit analysis, car transportation, and vehicle electrification policies. I'm impatient to hear his views because Norway is the most successful country in the adoption of electric vehicles, with almost 90% of new cars. Laurent Franckx is an economist specializing in transport and environmental economics. As a member of the energy and transport team at the Belgian Federal Planning Bureau, he is mainly responsible for modeling the composition of the car fleet and how it is affected by tax incentive. A warm welcome, Laurent. Tamara Sheldon is an associate professor of economics in the Darla Moore School of Business at the University of South Carolina. Her research interests include environmental and energy economics and how these fields interact with public policy. She has analyzed how numerous countries incentivize the adoption of electric vehicles, and I'm looking forward to your views, Tamara, on how IRA is changing this landscape. So a very warm welcome to the three of you. Each panelist will present initial remarks during about 10 minutes, and we will make sure to keep enough time to answer the questions. To ask a question, please open the Q&A window, which should be, in my case, at the bottom of my screen. I will monitor the inflow of questions and relay them to the panelists. This webinar, it will be recorded and it will be made available through our YouTube channel at the Council on Economic Policies. So without further ado, let me pass the floor to Askill to kick us off with the situation in Norway. Askill?
Thank you, Patrick. Thanks a lot for the invitation. Not surprisingly, I will talk mostly about experiences from Norway, but I will try to make it also relevant for the rest of the world. So I'm here to talk about research and not just show you statistics. But first, I just wanted to share the most recent statistics on EV sales in Norway. So the final numbers you see here are just from January. So obviously the numbers they go a bit up and down from month to month. But in January this year, the share of electric vehicles, and that is purely electric battery electric vehicles, is now 92% of new car sales. And then the share of diesel and gasoline vehicles is almost negligible. So of course, if you look at the total fleet, the numbers will look different, but this means that it's actually also starting to penetrate the total passenger car fleet. Of course, we can discuss how fast should this transition go, and what are the opportunities and pitfalls of the policies, and that's what we are here to do today. But I think we should also remind ourselves that eventually this is where we all need to go, and this also shows that it's actually possible. Today I will talk mostly about this paper of ours, which is a paper that's coming out now quite soon in the journal, which is about what we call local incentives for electric vehicles. And the incentives that we look at here are road tolls with exemptions for electric vehicles, and bus lanes that electric vehicles have access to. So I know that also Tamara has been looking at bus lanes or high occupancy lanes in previous work. So this is also good to have an opportunity to present this to you. We can do this both because Norway has a really high share of electric vehicles, so it's an interesting country to look at, but also because Norway and the other Scandinavian countries, we have really good access to administrative microdata for research. So we are using here data on all working households in Norway, and then we exploit individual variation in these incentives on the trip to work. And because people have different work trips, and that means that they are also adversely exposed to these incentives. So what we look at here is how does these differences affect EV ownership, and also driving of diesel and gasoline vehicles, and what are the potential unintended effects of these policies. So these are, of course, not the only incentives that we have in Norway. Norway has had a large battery of quite generous incentives for electric vehicles. It should be emphasized that these are mostly not subsidies in the strict sense. They are exemptions from taxes or other regulations that apply to conventional cars. Although maybe the exemption from the VAT tax, many would call it a subsidy. And some of these are national, some of them apply to the purchase of new vehicles, while some of them are more local and targeted at the use of different vehicles. And the ones that we look at are then the exemption from road tolls and access to bus lanes. And we look at the period where EVs have full exemption from road tolls. Nowadays, it's 50% in most areas, and also some areas have started to introduce 70% road tolls for EVs. So all these incentives are being partially reversed, but they are still quite generous. And we look at data covering the period until 2017. So of course that means that we are a few years back in time here. But even in that period, so we are focusing on the years 2015 to 17. Even then, Norway actually had the substantial share of EVs. So we're looking at a fairly mature car market. I don't have time to go much into the method, but what we do here is that we based on this administrative microdata, we have information about the neighborhood that people live in and the neighborhood that they work in. And then we can, based on the fastest route between these neighborhoods, we can calculate how exposed people are to road tolls and bus lanes on their trip to work. So we are not considering how much they actually pay in road tolls, but how much they would pay in road tolls if they commute by car every day. So that means that we are also able to capture the effect on car ownership decisions more generally. As you see on the map, these are fairly small neighborhoods. So even if we don't have the exact location of the home and the workplace, we have quite precise information about these incentives. And the blue dots that you see here are examples of toll gates. So some people pass a toll gate on their trip to work, and some people don't. So that gives us quite a lot of variation. So skipping then straight to the results, we see that, so you don't have to look so much on the table. I will try to summarize it for you. So plus 10 kroner, Norwegian kroner in road tolls on the trip to work, or about €1. I didn't check the currency rate for Swiss franc, but yeah, you can calculate that yourself. But that gives about a 1.4 percentage point, or about 37% increased probability of EV ownership, and an additional half kilometer of bus lane gives about 0.1 percentage probability increased probability of EV ownership, or about 3%. So the bus lane effect here, it looks smaller, but that is because we are here considering an average effect, an average increase in bus lanes, and most of the country doesn't have any bus lanes at all. You only have bus lanes in the bigger cities. So if you consider in the areas where people have maybe 10 kilometers of bus lanes or more on their work trip, you will then also get a bigger effect. So these are quite reasonable magnitudes, and it suggests that these incentives actually explain quite a lot of the increase in EV adoption that we had during this period. We also find a negative effect on ownership of diesel and gasoline cars, and also a negative but quite moderate effect on driving of these cars. So using this together, we are also able to calculate how much this contributes to reductions in CO2 emissions, and it actually accounts for quite a substantial decrease. We do find quite substantial heterogeneity in the results. So this shows that the effect on EV ownership is very small among the poorest households, which are the ones to the left here, and much larger among the richer households. And as a result of this, you actually see that poorer households, when they have road tolls on their trip to work, they tend to decrease their total car ownership, while the richer households tend to increase their total car ownership, possibly because they buy the EV as a second car. But then you should have in mind that this is a period where many EVs were not perfect substitutes for conventional cars, so that might change with newer data. We also compare our results with results from the period before EVs became an option. So we are comparing with the 2008 to 2010 period. And then we see that the combination of introducing EVs and EV incentives have amplified the negative effect on road tolls on ownership of diesel and gasoline cars. So that's good news. but also that this has dampened the sort of restrictive effect that road tolls have on total car ownership. So that suggests that you are stimulating higher car ownership, which might not be what you want, although it's not a very big effect. So this is our findings, and then I will try to come up with some possible implications or points for discussion. I will explain the picture in a few seconds. So the main message might be that incentives have worked. It's possible to stimulate a very high share of EV adoption based on these policies. Is there a value of Norway doing this so early? We don't really know. That's very difficult to answer, but some people claim that has also had an impact on the car market. We see that incentives tend to favor high-income groups, and that's of course something we should be aware of, but it's also something that's very difficult to avoid because most people don't have new cars. The people that have new cars will be high-income people. So during this stage of the transition, it's very difficult to avoid that kind of effects, I think. But distributional effects are not just about who is affected, it's also about whether you give people time to adapt, and that's something that I think we should be aware of. And one disadvantage of road tolls or road taxes on conventional cars is that it gives the consumers that have old cars, it gives them less time to adapt. While if you introduce purchase taxes, it only affects the people that buy new cars. And also, of course, generous EV incentives in urban areas could be in conflict with other policy goals, like that you want to reduce traffic in urban areas more generally. So to explain the picture, this is a suggestion that came up by the local government here just a few days ago, where they actually proposed to have a very high road toll on diesel and gasoline cars, but only on new diesel and gasoline cars. So I'm not saying that this is a good suggestion, but it partially addresses some of these points that you give consumers more time to adapt, and you don't hurt the ones that have old cars and low income to the same extent. I will stop there. Thank you.
Thank you, Askill. Next, we go to the US with Tamara Sheldon. Tamara?
Great. Thank you. It's so great to be here. So today I'm going to be talking a little bit about the cost effectiveness as well as the equity of EV subsidies, and I'm going to also look at the context of the Inflation Reduction Act and the policy updates in the United States. In my research, one of the things I do is I measure cost effectiveness of EV subsidies like tax credits and rebates. And this slide shows conceptually how I do that. So on the left here, it shows that if there is no subsidy, no tax credit, no rebate for EVs, there's 3 people buying an EV. Okay, so these 3 people, they want an EV, they're willing to pay the full price for it and buy that EV, even if they do not receive a subsidy. Then suppose we have a subsidy. In the US, the federal subsidy has been up to $7,500, so most EVs qualify for the $7,500. And when we have the subsidy, these three EV buyers, even though they're willing to pay full price, they're not going to leave money on the table, right? They're going to apply for the subsidy and receive the $7,500. But the subsidy has induced one more EV buyer. So this green car represents someone who would not have purchased an EV without a subsidy, but they are going to buy the EV now that there's a subsidy. So we're calling this green car the additional or the marginal buyer who's induced by the subsidy policy. So the total cost of the policy is 4 times that $7,500 subsidy, which is $30,000. And the policy has resulted in 1 additional EV purchase. So I can define the cost per additional EV purchase as $30,000, right? The $30,000 policy cost divided by 1 additional EV. So $30,000 sounds like a lot of money to achieve one additional EV purchase. It turns out this is right about the actual number that I estimate in my research. So these EV subsidies are quite expensive in achieving the policy goals. And I think, Patrick mentioned at the beginning that these policies are somewhat controversial, are being phased out in certain geographies. And I believe this is part of why they're controversial. They're expensive. Of course, they're quite popular with consumers. So in my research to estimate this cost effectiveness measure, my co-authors and I, we use new vehicle purchase data or vehicle registration data to estimate vehicle choice models, conditional logits, mixed logits, where we essentially estimate the probability of consumers choosing a vehicle based on its characteristics. We use the estimated or calibrated model to predict EV purchases both with and without the subsidy, and that allows us to calculate the cost per EV, per additional EV, as the total cost of the subsidy divided by the total number of additional EVs purchased as a result of the policy. I have a number of papers where we've done this type of analysis. I started working in California, expanded to look at the whole US federal policy. Co-author and I have a paper looking at China's market, and more recently, we've done this type of analysis for many of the countries in the G20 that offer some sort of tax credit or rebate or direct consumer subsidy. Here's a table that summarizes the results of some of that work. So you can see the different geographies that we look at, the policy years that we look at, the specific policy that we analyze. So the first paper that we did, we looked just at California's rebate policy, and we calculated a cost per additional EV of $30,000. In the US, for the federal policy, we found a cost of $35,000 per additional EV. In China, we got a number of $24,000. In various G20 countries, we've calculated anywhere from $15,000 to $45,000 with a mean and median of $25,000. As a point of comparison, Tal and Nicholas from UC Davis, they've done similar work showing a cost of $14,000 to $53,000 per additional EV purchase, and they calculate that by model type. The lowest number we found is in California, so $17,000 to $22,000 per additional EV. And that comes from a really particular context, which is a program that targets low and middle income households with these subsidies. So from that paper and some of our other work, one thing that we've shown is we can improve cost effectiveness of these subsidies or reduce that cost per additional EV by income-based targeting. So income-based targeting means we give larger subsidies to low-income households and smaller subsidies or even eliminate subsidies for higher-income households. And here's the intuition of how that improves cost effectiveness. First of all, under no subsidy, there's fewer lower-income households purchasing the EVs without the subsidy. So there's less of these non-marginal consumers, less of these blue cars. Say we give these lower income households a larger subsidy of $10,000, lower income people tend to be more price responsive. So that results in 2 additional EV purchases, 2 of these green cars. Total policy cost is still $30,000. The increase in EVs is 2, and that leads to a cost per additional EV of $15,000. So the cost per additional EV has been halved relative to that first slide that I showed you. So to improve cost effectiveness, we want to reduce the number of blue cars. So EVs that would be purchased without the subsidy. And we want to increase the number of additional purchases. And targeting lower income consumers tends to do this. I'm not going to read all of the bullets on this slide. I've done some work looking at EV policy and equity. So all of these bullet points come from a review article I wrote on equity and EV policy. There's a lot of inequities around EVs. Think about differential access to charging infrastructure. There's some work showing that higher income households benefit more from EVs in terms of improved air quality. So there's a lot of issues here, but what I want to highlight in this context is that in the US, the vast majority of those subsidy dollars are going to households with an income over $100,000 annually. And based on some of my work on equity and the research that I did on cost effectiveness, I wrote an editorial in May of 2022 called Make EVs Affordable for the Rest of Us. And in that editorial, I make 6 suggestions for how we can improve equity. The first is to place a price cap on eligible EVs. The second is to increase subsidies for lower income households and eliminate them for the highest income households. And 1 and 2 combined, those improve equity by funneling more of the subsidy dollars to lower income households. And as our research has shown, that can also improve cost effectiveness of the subsidies. We also recommend giving subsidies closer to the point of sale. So it used to be that in the US, to get that federal tax credit, you'd have to wait months or even a year until tax time to realize that credit. And of course, for low-income households who are more budget constrained, they could use that money up front. We recommend offering cheaper loans, scaling subsidies by electric mileage, and subsidizing used EVs. So Askill pointed to this earlier, that it's mostly high-income people who are buying new cars, right? Low-income people tend to not buy so many new vehicles. And so we can consider subsidizing used EVs. So enter the Inflation Reduction Act of 2022, which came out in August of 2022. There was a lot of kind of big updates to the US federal EV subsidy policy. So they extended it to 2032 for all EVs manufactured by all manufacturers. They implemented an MSRP cap, that's a price cap, an income cap, and they've made a measure where a tax credit can effectively be realized as a rebate. So I'm going to talk more about those 3 aspects on the next slide. Furthermore, for an EV to qualify for the subsidy, it must have final assembly in North America. There's a requirement that a certain percent of the critical minerals like lithium and cobalt in the batteries are either mined or processed in the United States or in a country with whom we have a free trade agreement. There's also a requirement that a certain percent of the battery components are manufactured or assembled in North America. So these percents are increasing over time. And furthermore, starting in 2024 and 2025, critical minerals and battery components cannot be purchased from foreign entities of concern, which include China, Russia, North Korea, and Iran. The maximum tax credit remains $7,500. That used to be a function of battery size. Now that is purely a function of these requirements. So if an EV satisfies the critical mineral requirement, it qualifies for half of the tax credit. If it satisfies the battery component requirement, it qualifies for the other half of the tax credit. So what are the impacts, or what are the likely impacts of the IRA on cost effectiveness and equity? Well, back to the price limits. So now EVs that are SUVs, vans, or pickup trucks only qualify for the credit if they cost $80,000 or less. For other vehicle types, they only qualify for the credit if they cost $55,000 or less. There's also income limits. So an individual can only qualify for the tax credit if they make $150,000 a year or less, or for a household, that would be $300,000 or less. So the price limit and the income limit, that definitely is going to improve equity, because again, more of these subsidy dollars will go to lower income households and moderate income households, right? These income limits are fairly high. And our research has shown that this is also likely to improve cost effectiveness, as I explained earlier. Furthermore, the IRA allows an individual to transfer their tax credit to the dealer at the point of sale, and the dealer can pass that through as essentially a rebate. So households can now receive this tax credit effectively at the point of sale, lowering the purchase price, and that should also improve equity, as it'll make that upfront purchase price more attainable for more households. New in the Inflation Reduction Act is also a used EV tax credit. I think this is huge. Okay, so used EVs, if they're sold at a dealership, qualify for a $4,000 tax credit. So that right there is going to improve equity. It's going to expand the market for lower income households to buy an EV. There is a price cap of $25,000, and there's income limits that are lower than for a new EV. So those should improve equity and cost effectiveness. So I'm really excited about this. There's not a whole lot of data out there to actually analyze how it's going, but I look forward to researching this more in the future. So far things are looking pretty good with the Inflation Reduction Act. However, there's a loophole. Okay, new in the IRA is a commercial EV tax credit. And commercial EVs, so sold for commercial buses or commercial fleets, they also qualify for a $7,500 tax credit. There are no battery or mineral sourcing requirements. Because it's for commercial purposes, there's no income limit. There's also no MSRP or price limit. And it turns out that the way these commercial vehicles are defined, vehicles purchased by a dealership to lease to consumers qualify for this commercial tax credit. So that means a high-income household can lease any EV they want, including a very expensive luxury EV, and that $7,500 credit can be passed on as a discounted lease to those consumers. So this is not good for cost effectiveness or for equity. It will likely counteract some of the gains made from the other components of the policy. So that's all I have prepared. Thanks so much for your time. Look forward to your questions.
Thank you, Tamara. This was very interesting, very helpful. I think you made a good point showing that IRA was initially criticized for being too rigid regarding domestic content and critical material, but you clearly said that there are also a lot of flexibility in IRA, for instance, in terms of applying the tax credit to used cars. Also, the leasing loophole is a form of flexibility, maybe too much flexibility. Also, the tax credit, you say, can be transferred, and I believe is also refundable if people don't pay taxes. So thanks for a very good overview. And now we turn to Laurent. Yeah, Laurent, you have the floor. Laurent, we cannot hear you.
Sorry. Okay. So I should have started sharing my screen now. So I'm going to talk about two green tax reforms in Belgium with, well, two types of assessments. There's one ex-post assessment of a tax reform that was introduced about a decade ago, and then there's also an ex-ante evaluation of a tax reform that is going to take effect in a few years from now. So maybe first a very short introduction to car taxation in Belgium, just to give an idea of the different types of taxes that cars are subject to. First of all, well, every car that is purchased in Belgium is subject to a license tax. So that's not just for the first purchase, but also on the second-hand market. And then there is also an annual traffic tax that is levied on any car that is registered in Belgium. Now, what's interesting here is that the competence of determining the levels of these taxes is a regional competence. So in Wallonia and Brussels, it's determined uniquely by the taxable horsepower, while in the Flemish region of Belgium, there's also a surcharge that depends on CO2 emissions and Euroclass. For the people who are not familiar with European legislation on emissions from cars. So the Euroclass of a car determines the emissions of local pollutants of a car. So that's the particulate matter, NOx, etc., carbon monoxide. So the Euroclass of a vehicle determines these type of emissions. Now, a topic that's quite important in Belgium is the issue of company cars, because more than half of the new cars sold on the Belgian market are company cars. And it's a hugely controversial subject in Belgium, because there is a huge implicit subsidy on the use of company cars for private purposes. And so first of all, if as an employee, you can use a company car, you are completely exempted from any contributions to social security system. Again, for people who are not familiar with the Belgian tax system, and so everything that's related to social security, so that's not just pensions, but also healthcare, unemployment insurance, etc., is funded by payroll taxes. And if you can use a company car, although you receive a benefit in kind, you are completely exempted from any contributions to the social security system. On top of that, in Belgium, the employers also have to pay contributions to the social security system, which is proportional to the gross salary of the employees. But again, if you can use a company car, the employer solidarity contribution is completely independent from the real value of the benefit in kind, and only depends on the CO2 emissions of the car, which is obviously intended to incentivize the purchase of low CO2 cars, but again creates a huge implicit subsidy element, because it's completely disconnected from the real value of the car. Then there's the value-added taxes. So there, the share of the value-added tax that is deductible is proportional to the professional use of the company car. But in the absence of real observed data on the share of private kilometers, it's usually based on default rulings with the tax administration. And then the final issue is the taxation of the benefit in kind in income taxation. And so the benefit in kind depends on three parameters. So it's the catalog value of the car. So not the actual price paid by the company who purchased the car, but the catalog value. It's multiplied by CO2 coefficients, which changes each year and is adapted to take into account the average CO2 emissions according to the test cycle of new cars that are put on the Belgian market. And again, it's obviously meant to incentivize the purchase of cars with low CO2 emissions. And all this is multiplied by 6 divided by 7. And please do not ask me where this factor comes from. I have no idea, and I haven't yet met anyone who's able to explain where this 6 divided by 7 comes from. Then there's also the issue of the treatment in corporate taxation. So the deductibility of company cars in corporate taxations, again, depends on the CO2 emissions of the cars. And until recently, the deduction percentage for electric cars was equal to 120%. And then the final point is that a part of the benefit in kind, of the taxable amount of the benefit in kind, is part of disallowed expenses in corporate taxation, which means it's deducted from the costs that are deductible from the corporate profits. Okay, so the first policy reform I'm going to discuss now is the reform of license tax and road taxes in Flanders. So as I said in the beginning, the determination of the license tax and the annual road tax is a regional competence that was introduced by the constitutional reform of 1989. And until now, two of the three regions, Brussels, the region of Brussels and Wallonia, have maintained the old system where these taxes were determined uniquely as a function of a car's fiscal horsepower, which means the engine size and or the maximum power of the car. And in 2012, Flanders has introduced unilaterally a complete overhaul of taxes, in the sense that it depends on the CO2 emissions of the car and its Euro class for pollutant emissions. I'm not going to give the complete formula here, but I don't think that that's important. And then 2016, there was a second reform where Flanders added 2 correction terms to the annual road tax, again to take into account the Euro class and the CO2 emissions, and also introduced a premium for the purchase of electric cars, which was again abolished in 2019. So what we got here is, I think, the economist's dream of a natural experiment, with Flanders as a treatment group and the other 2 regions as a control group, to test whether these tax reforms have caused a change in the environmental performance of cars. So I'm not going to get you through the whole econometric analysis. I think the results are the most important point. Just in terms of descriptive statistics, what I show here is the evolution of the average CO2 emissions for new cars per tax regime and fuel type. So on the left panel, there is the evolution for the privately owned cars. On the right panel for company cars. So the red lines represent the evolution of the CO2 emissions in gram per kilometer in Flanders, and then the blue, it's in the rest of Belgium. ROP is rest of Belgium. So distinguish between diesel and gasoline cars. So what we see is both for privately owned cars and for company cars, and in the 3 regions, the general tendency is for CO2 emissions to decrease over time. Okay. You also see why it's important to make distinction between privately owned cars and company cars, because company cars started from a much higher level back in 2007 than privately owned cars. So what changed there is that until 2007, the treatment of company cars in so the calculation of the benefit in kind depended also on just the fiscal horsepower of the car. It's only after that incentives were introduced to reduce the CO2 emissions of company cars. What you also see is that the tendency for CO2 emissions to decrease exists both in Flanders and in the other regions, and also that CO2 emissions are higher in Flanders than in the other regions, which probably to a large extent reflects higher average incomes of households in Flanders. Now, the results are well, technically speaking, what I did here is a difference in differences analysis with tests for parallel trends. If you're interested in technicalities, I can send you a copy of the working paper. But so the main conclusions is that from 2012, so the year of the reform of the license tax, until 2016, average CO2 emissions outside of Flanders decreased on average with around 22 grams per kilometer for private cars and 38 for company cars. And in Flanders, the additional effect was around 1.5 gram per kilometer for private cars and around 7 grams per kilometer for company cars. Now, so these results are highly statistically significant. But the question we could ask ourselves is this additional effect in Flanders large or not? It's very interesting because just 2 weeks ago, I participated in a conference on Belgian Environmental Economics Day. And there in the public, I said, well, the additional effect is statistically significant, but it's small. And there was someone in the public who disagreed and said, well, there's actually a quite large additional effect. Well, that's a value judgment, of course, but I think the additional effect is certainly not huge. And the question is why? Well, if you look at the parameters that determine the Flemish tax, like CO2 emissions, but they are actually very highly correlated with the fiscal horsepower of a car. It's not perfectly correlated, but it's sufficiently correlated to make sure that actually the two taxes remain very highly correlated even after the reform. And what's even more important is that the license tax is actually quite small compared to the purchase price of new cars, and certainly compared to the total cost of ownership of a car, we're talking about something that represents less than a few percent at the most. And if then we look at the additional effect of the reform of the annual road tax in 2016, well, in that case, the additional effect is even smaller. And in the case of privately owned cars, it's not even significant. Again, why? Well, you already had the reform of the license tax in 2012, had already created quite strong, had already created incentives for an accelerated reduction in CO2 emissions. And then again, there's the issue of the correlation between the reformed annual road tax and the annual road tax like it existed before. Okay. Well, that's an exposed evaluation based on an econometric evaluation. Next topic I would like to talk about is a recent reform of company car taxation in Belgium. So what happened there is that in 2021, there was the law on the fiscal and social greening of mobility, which eliminates completely the deductibility of corporate company cars costs in corporate taxation, except for cars with zero CO2 emissions. Now, what's maybe also interesting to point out is the political context. So company cars are a very contentious topic in Belgium because they have a very high share. And they are mostly given to employees as a way to avoid high marginal tax rates and avoid high contributions to social security. Okay, so it's really part of the payroll policies of companies to give company cars, but it's also, well, in terms of there is a huge discussion about the impact on the environment, where you have two opposing forces in the sense that company cars tend to have to be more recent than privately owned cars, so they perform better in terms of local pollutants. But then on the other hand, they tend to be heavier and more powerful than privately owned cars. And so all other things being equal, they have higher CO2 emissions. And then there's also the fact that, well, that the existence of company cars and the way the benefit in kind is treated in income taxation means that you have different forms of incomes that are treated differently in income taxation. So it's a sort of completely arbitrary differences in marginal tax rates. But it's more or less political, well, it's very difficult politically to reform this. But so the idea here of the government was, okay, we're not going to touch about the principle of the favorable tax treatment, but we're going to touch the issue of the environmental performance, right? So it doesn't change at all the way the income the company cars are treated in income taxes or in social security contributions, but just in corporate taxation. So we did an evaluation with the simulation model, the car stock model for Belgium. So we did the simulation with and without the reform. So the reference scenario takes into account all decided policies, including the European phase out of IC cars from 2035 on. So the results, main results, well, here I give a presentation of the expected evolution of the company car stock. So in the reference scenario, so that's a no reform scenario. And this is a scenario with the tax reform. And so the gray area is electric cars. And maybe what's most interesting is to look at the difference between the two scenarios, and to look at that the impact is a strong increase in the number of electric cars. And the main victims, if I can say, are plug-in hybrids. Why? Because in the current system, where the corporate tax deduction depends on test cycle CO2 emissions, the theoretical CO2 emissions of plug-in hybrids is very low. So they already enjoy a very high level of corporate tax deductibility. And so what happens is with the tax reform, this corporate tax deductibility is reduced to zero. That's also the case for diesel and gasoline cars, but the relative effect is much larger for the plug-in hybrids. What you also see is that the difference between the two scenarios becomes smaller from 2035 on. That's, of course, the result of the European ban on the sale of new ICE cars as from 2035. What's also interesting is to look at the impact on income on tax income for the government. So there are distinguished between two types of taxes. So all the taxes are related to the use of cars. So that's the excise and the value-added taxes on fuel consumption. It's the annual road tax. It's all taxes that are related to the annual use of the cars. And as we've seen, all these taxes actually depend on the CO2 emissions of a car. So what happens is, due to reform, because it leads to an accelerated reduction, an accelerated electrification of the company car stock, the impact is that all these income sources will decrease through time. Excise revenues will diminish through time. The annual road tax incomes will decrease through time, etc. And then what's even more interesting is to look at the issue of the foregone corporate tax revenues, because what was quite unexpected when the Ministry of Finance asked us to make this evaluation was that because of the very high deductibility of plug-in hybrids, in the second half of this decade will be a huge explosion, really, in the corporate tax deductions of plug-in hybrids. Again, because, well, we observed that there's a very large increase in the number of plug-in hybrids in company car fleets. And this, in combination with the very high deductibility based on the, we know, theoretical CO2 emissions, would have led to an important decrease in the incomes from corporate taxation. And what happens is that as a result of the tax reforms, these losses completely disappear. Okay, then we maintain the tax deductibility of electric cars. So that's the gray line here. So because the number of electric cars increases through time, and this deducted taxes will also increase through time. But so the net effect is actually a decrease in the losses due to the corporate tax deductibility of company cars. And well, that's it. So this is an ex-ante evaluation. We will now have to see how things further evolve through time. But anyway, when you look at the share of electric cars in new company car sales, they are increasing quite quickly. And we certainly have no reason at this time to think that we will be far off in terms of the projections we made.
Thank you, Laurent, very much. It was very interesting, and thank you for touching on the corporate tax aspect of it, which is often forgotten. And corporate car fleet have been a big source of emissions because they tend to be more polluting cars in many countries. So that was very useful. We don't have a lot of time left, but maybe we try to answer the question that came in the chat, maybe with brief remarks. There's an interesting question around charging stations and EVs. The two are correlated. For EVs to be practically used, you need charging station, but for charging station to be a worthwhile investment, you need EVs. So it's a chicken and egg issue. And the question is, should policymakers provide a tax incentive for EVs, charging stations, or both? Any view on that, Askill?
It's a tricky question. I know there's a small literature on that. I'm not that familiar with it myself, but obviously you can do both. I think given that many people also charge at home, it makes sense to also stimulate EV adoption directly and not just via the charging market. But yeah, it's difficult to give a clear answer.
Maybe Tamara, do you have views on that? And I know some of the IRA has a tax incentive for charging station as well.
I'm sorry, can you repeat the question? I've been attempting to respond to some of the chats in the text.
Yeah, do you have views about the economic effectiveness of providing tax credit for charging stations?
My personal opinion is that will not be sufficient, because I think as EVs penetrate further and further into the market, we're going to be dealing with consumers who maybe live in multifamily housing and could not install home chargers. Furthermore, evidence has shown that utilization of public charging stations in the US is very low. Most of the public charging stations are rarely used. There's a handful of very popular stations that are used a lot. And so while adding more charging stations can help reduce range anxiety, the underutilization of so many public chargers suggests to me that is not currently the binding constraint on moving the needle on EV adoption.
Mm-hmm.
Okay.
I think it's it's a quite interesting question, because I'm just finalizing a report on the issue of charging stations in Belgium, and well, again, as always, it's differentiated according to the regions, and I think what's quite interesting is to see that, for instance, in Flanders and in the Brussels regions, there are no subsidies at all for charging stations. So it's commercial contracts. So there is a call for tender that's to which potential charges can respond, and it's not subsidized. But what the government does is follow the car follows the client policy. So everyone who's unable to charge at home, and in cities, of course, that's quite a lot of people. So if you're not allowed to, if you cannot charge at home, and you don't have a charging station within, I think it's 200 meters of your home, you can ask the government to install a charging station close to your home. Of course, it will be a public charging station, it will not just be available for you. Thus, the result of this is that you get a quite quick rollout of charging stations, that follows really the needs of the market, right? But there's no financial subsidy element in this.
Okay. Is a question also, maybe Tamara, on you touched upon the transfer of the tax credit to the car dealer. And I think that raises the interesting issue of incidents. In other words, when you transfer the car dealer, is the tax credit going to benefit the driver or the car dealer? Any views on that?
Yes, so I did try to answer that question in the chat, but the way, so it is, it's a tax credit that counteracts your personal income taxes, so not sales tax, to clarify. That was part of the question. But basically, the dealer is supposed to reduce the purchase price or reduce the down payment by the amount of the tax credit. And then just brand new, starting in January of 2024, there's an IRS website that the dealers must register and they input the vehicle sale, and the IRS supposedly promptly pays them the amount of the $7,500 that they've passed on to the consumer. And so the issue is this going to result in dealers raising their prices to capture some of that subsidy? And it's quite possible. However, I don't think this is a new issue with the point of sale rebate. This has always been an issue, right? Even when it was a $7,500 tax credit that you claim at tax time, dealers know, if they know that you're going to get that $7,500 back on your taxes, they might choose to raise the prices a little bit to effectively capture some of that tax credit. So I don't think this is a new issue. It is an issue. There has not been robust research that I'm aware of examining the incidence. There was a really nice paper done by Jim Sully a while back looking at the old incentives for hybrid vehicles. And he showed that consumers fully captured the subsidies for hybrids. And all of the anecdotal evidence that we have points to consumers capturing most of the tax credit. So it doesn't seem to be a problem yet, but it's something to be mindful of going forward. I'm particularly concerned about that in the used vehicle market now that we have that used EV tax credit, because I think pricing of used EVs is less straightforward, it's less transparent, and it might be easier for the dealers to try to behave strategically in their pricing of the used EVs. So it's something for us to research going forward, but it doesn't appear to be a huge issue at the moment.
No, thank you for that, Tamara. And I think it's always the question with a tax credit to know who benefits in the end. And I remember important research on the US earned income tax credit, the EITC, showing that the benefit of the EITC goes to some extent to the employer rather than the worker. Something to keep in mind. But we have to close soon. But before closing, I would like to go back to you, Askill. Since Norway has been ahead of everybody else, any advice based on your experience you want to give? Norway has been using, I guess, everything that's possible, from tax credit to free parking space to free total, even free ferry rides, I think. Do you see any of these policy instruments being particularly effective? Or is it the, as was asked in the chat room, the interaction, the complementarity between these very different tools?
Right. Yes. Thank you. Yeah, I think it has a lot to do with the sum of all these incentives. So obviously the effect of one incentive is conditional on all the other incentives being in place. We don't have any very good evidence on how they compare. My impression so far is that the road toll the effect of that is quite comparable to the effect of purchase incentives if you calculate what it's what it's worth over the expected lifetime. So I think the most important thing to have in mind is that the reason why Norway was able to have such generous incentives is that we actually had quite high taxes on cars to begin with. So Norway and Denmark also have very high taxes on new passenger cars. And that means that it was also possible to introduce high tax exemptions for EVs. So it's a huge loss in government revenue, but it's compared to taxes that were high to begin with. I think the most important message from my point of view is the trade-off between EV adoption and reducing car travel in urban areas. That in Norway we actually have more generous incentives in urban areas to some extent, because there we have high road tolls, and also the local governments have their ambitious climate policy goals. And that doesn't really make sense from an economic point of view, that you want to introduce more car travel in the areas where it creates the most problems. So I think have either to have national incentives or to have some local incentives that also applies outside the cities.
Thank you very much, Askill. I'm afraid we've run out of time, so I would like to thank you very much, the three panel speakers, Askill, Tamara, and Laurent, for participating today and presenting excellent remarks. I would like also to thank the audience for participating and asking questions. This has been a great opportunity to learn from the way different countries support the adoption of EVs and how to identify good practices. Clearly, EVs are an important part of the solution to go toward net zero, but it's not the only solution. Other solutions include micro cars rather than SUVs, carpooling for groups of workers, reliable and affordable train transportation, and innovation like automated vehicles. So it's not one size fits all, but many solutions to sustainable transportation in the long run. And obviously, rethinking urban development will also have to play a role to reach net zero in the long run. So a task for all of us is to provide advice to policymakers on how tax policy and fiscal incentives can help, both effectively and equitably. So with this, I would like to thank you, all of you, once again. Thank you very much, and goodbye.